You're listening to Nora and Noah Decode the Day, where markets meet meaning every morning.
It's always striking how even just a hint of major economic shifts can ripple through the markets, isn't it?
Definitely.
We saw that just recently. Former President Trump voiced some, surprising optimism about trade talks, Japan, Mexico, the EU, even China. And the markets, they reacted, at least for a bit.
It really just highlights how sensitive everything is to trade policy, and it sets the stage perfectly for looking at these really complex forces at play right now.
Absolutely, because that initial market jump, that's just like one tiny piece of a much bigger puzzle.
A very intricate puzzle.
Yeah. So for this deep dive, we've pulled together a pretty interesting mix of sources. We're looking at analyses of those trade talks, central bank moves, tech earnings, key economic numbers.
A bit of everything.
Right. And the goal today is to really try and connect the dots, between Trump's trade optimism, his comments about Fed Chair Powell, what the actual economic data is telling us, and how different industries are doing. We want to cut through the headlines a bit.
Exactly. It's all about seeing how these things link up. Trade talks, monetary policy, business results, economic data, they're all influencing each other constantly. It's fascinating.
Okay, so let's jump right into that trade optimism then. Trump's saying big progress with Japan, feeling good about deals with the EU and China, even saying they're the ones who are more eager. What's the reality check there?
Well, if we focus on Japan first, while Trump sounded upbeat, Japan's Prime Minister, Ishiba Shigeru, was, let's say, more measured after his team briefed him.
Ah, okay.
He said they had constructive discussions, sure, but he also stressed that, quote, differences in position still exist. So doesn't sound like a done deal is imminent.
Right, and the reports we saw laid out some of those sticking points.
Yeah.
3 main U.S. concerns with Japan, right? Burden sharing for U.S. troops there.
Yep.
Low sales of American cars in Japan.
A classic one.
And the overall trade deficit. And they're
Yeah.
planning to meet again this month, I believe.
That's right. Talks are ongoing. And then there's another layer here, this report suggesting the U.S. might be pressuring Japan to limit its trade with China.
Ooh, that's tricky for Japan.
Very tricky.
Oh.
Because Japan's economic ties with China are actually really strong, maybe even stronger than with the U.S. directly in some ways. Lots of Japanese businesses rely heavily on China.
And didn't we see something about a Japanese delegation heading to China soon?
Yeah, exactly. It just shows the tightrope Japan is walking, balancing the U.S. security alliance with its huge economic interests in China.
Okay, so Japan's in a bit of a bind. What about the EU? Trump sounded positive there, too.
Well, the EU situation also has its challenges. Talks are happening, but reports suggest the EU is actually thinking about potential retaliation if things go south.
Retaliation? Like what?
Specifically looking at maybe restricting exports of critical goods to the U.S. Essential stuff the U.S. needs and might struggle to get elsewhere. Kind of like China's leverage with rare earths.
Wow, okay. That's playing hardball. And it sounds like all this trade uncertainty is having wider effects for them.
It seems so. The same report mentioned EU financial authorities are starting to wonder if U.S. Treasury bonds are still the super safe asset they used to be.
Really? Why the change?
Well, think about the increased volatility in the bond market lately, plus these growing fears of a potential U.S. recession. A lot of that is being fueled by this trade uncertainty and the threat of more tariffs.
And if they start seeing treasuries as riskier?
It could force big European institutions, like insurers, to potentially sell off large holdings. It's not just about selling. It could fundamentally shift how global risk is assessed and make borrowing more expensive for the U.S. down the road. It's like a subtle crack in the foundation of global finance, potentially.
That could definitely send ripples. Okay, shifting slightly but still international, there was that report about China supposedly helping Yemen's Houthis target U.S. warships. How does that fit into the U.S.-China trade picture?
That's a big one, geopolitically. It could seriously complicate things. Anything seen as undermining U.S. security could easily spill over into the economic talks, making an already tough negotiation even harder. Could definitely ratchet up tensions.
Man, it really feels like for every positive trade comment, there's something else pushing back, creating headwind.
It does feel that way.
But then we also saw that view from UBS suggesting a U.S.-China compromise might actually be the most likely outcome, maybe even rolling back some tariffs.
That's right. UBS thinks, despite all the friction, both sides still have a strong incentive to de-escalate eventually. Their analysis pointed to maybe rolling tariffs back to around, say, 34%, a level where trade could still function, even if it's not totally smooth.
So a really mixed, uncertain view on trade overall. Okay, let's pivot to another area of tension. Trump versus the Fed, specifically his wanting Chair Powell out. He was blunt, said Powell's termination cannot come fast enough, called his past statements always too late and wrong. What's the urgency there from his perspective?
It really seems to boil down to a fundamental disagreement on interest rates. Trump appears to believe Powell's been too slow to cut rates, and that's holding back economic growth unnecessarily.
And this is happening while other central banks are cutting.
Exactly. Look at the European Central Bank. The reports noted they just cut rates for the 7th time. And they explicitly mentioned persistent trade tensions and rising deflationary pressure as reasons why.
That's a really stark contrast, isn't it? The ECB easing, while Powell's sounding much more cautious. What's his exact reasoning?
Powell's basically saying the Fed wants to wait for clearer economic signals before making any moves. He's also highlighted that tension in their dual mandate, maximum employment versus price stability.
Right, keeping people employed but also controlling inflation.
And right now, Powell's signaling that controlling inflation, ensuring price stability, is the top priority. And others at the Fed, like New York Fed President John Williams, seem to agree. Williams said recently that near-term rate changes aren't needed. And actually, tariffs are likely to push inflation up and slow growth down.
Okay, so Powell's focused on inflation, wants more data, and sees tariffs as potentially making things worse. Meanwhile, we hear about these behind-the-scenes talks about actually removing him.
Yeah, the Wall Street Journal reported on those internal discussions. Trump apparently talked to potential replacements, like former Fed Governor Kevin Warsh.
But not everyone in the administration was on board.
No. Treasury Secretary Scott Bessent reportedly argued strongly against it. He basically said the potential downsides hugely outweigh any benefits, stressing how vital Fed independence is. He even called it a jewel box that needs protecting.
And the legality of firing him, that seems murky too, right? Can Trump even do that before Powell's term as chair is up next May?
That's a huge question mark.
Yeah.
Trump has removed heads of other independent agencies, like the FTC and NLRB. But the legal ground for firing a Fed chair early, much less clear.
I remember something about a Supreme Court case involving the NLRB.
Right, that case gets brought up. But interestingly, the Treasury Department itself argued in that case that the rules for Fed officials' terms are different, legally speaking. And Powell himself has publicly stated he believes the law protects the Fed's independence.
So what do the legal experts think?
Most seem to agree that trying to fire Powell would almost certainly trigger a major legal fight. And that could drag on, maybe keeping Powell in place until his term ends anyway.
A messy legal battle, potentially. But putting the legal side aside for a second, what would the market reaction likely be if Trump did manage to remove Powell?
Oh, it could be pretty significant and probably not good. It would likely create a lot of nervousness, uncertainty for investors. You could see confidence in U.S. Treasury shaken, maybe the dollar weakening.
And what if the White House then pressured a new Fed chair to cut rates while tariffs are pushing inflation up?
That's the nightmare scenario for many analysts. Big risk of runaway inflation. RSM warned that kind of trade shock can lead to stagflation. Slow growth, high inflation, rising unemployment, and cutting rates then would be the wrong move, just pouring fuel on the fire.
I remember Olivier Blanchard also warned about messing with central bank independence.
Yeah, especially when government spending isn't exactly tight. He stressed the risks are much higher if investors start doubting the Fed is truly independent. Forex Live echoed that politically driven rate cuts could mean more inflation, a weaker dollar, and treasuries, maybe gold goes up.
The Forex Live also thought Congress might step in.
They did suggest Congress would likely try to prevent the worst-case scenario. But still, the consensus seems clear. Messing with Fed independence, especially now with all this trade stuff swirling, is playing with fire. Could be really destabilizing.
Okay, so serious potential fallout there. Now let's talk about how these trade tensions and potential policy shifts are actually hitting businesses and maybe fueling inflation. We're seeing companies speak out.
Yeah, definitely. Ford, for instance, basically warned that if these tariff plans stick, they'll probably have to raise prices on new cars, SUVs, trucks, maybe as early as this summer.
Ouch. And Alcoa,
the aluminum giant. They said aluminum tariffs cost them about $20 million just in the first quarter, and they expect that to jump to maybe $90 million in Q2.
Wow.
And they also poured some cold water on the idea of quickly ramping up U.S. aluminum production to replace imports. It takes huge amounts of energy, they said, and they still rely heavily on imports from Canada anyway.
So real costs hitting businesses, likely getting passed on to consumers, pushing inflation. But then we saw that kind of surprising take from Blackstone on real estate.
Yeah, that was interesting. Blackstone suggested tariffs could actually be a tailwind for real estate values, assuming we don't hit a major recession.
A tailwind.
Their logic is tariffs push up construction material costs and make it harder to build new supply. And since new construction, especially in things like logistics and apartments, is already way down lowest in a decade, apparently limiting supply further while costs go up could actually boost the value of existing properties.
Huh. Interesting. But doesn't that also make you worry about housing affordability? I mean, it's a tailwind for property owners, but what about people trying to buy or rent?
That's a very fair point. It highlights a potential downside for affordability, even if asset values rise for current owners.
Okay, let's look at the recent economic numbers, the hard data. What's that telling us about the economy's health overall?
It's a bit of a mixed bag, honestly. On the
Yeah.
plus side, weekly jobless claims came in lower than expected. Good sign for the labor market. But continuing claims, people staying on unemployment, ticked up slightly above forecasts. Housing data was also mixed. Housing starts dropped quite a bit in March, lowest in 4 months. But building permits, which hint at future building, edged up a little.
Any really concerning signals in the data?
The one that really stood out was the Philly Fed's manufacturing index. It plunged. Lowest level in 2 years. Big drops in new orders, shipments, employment. And at the same time, the prices manufacturers are paying for inputs shot up noticeably.
Oof. That sounds like...
Yeah, that combination really raises the flag for potential stagflation. Again, slow growth, rising prices. It's a tricky spot for policymakers.
That Philly Fed number is definitely a warning sign, especially the input prices rising. But then, countering that, we keep hearing consumer spending is holding up pretty well.
That's the key counterpoint. Absolutely. Despite weak spots like manufacturing and housing, the consumer seems pretty resilient. March, retail sales were strong.
Right.
American Express beat earnings expectations, thanks to strong spending by their cardholders. JP Morgan looked at their Chase card data and thinks retail sales kept growing in April. Bank of America saw higher household spending too.
Even travel numbers. Weren't some airlines sounding gloomy?
Yet, some airlines were pessimistic about demand, but the actual TSA checkpoint numbers, while only up slightly, didn't show a big drop-off. So yeah, consumers are still spending, which is, a massive engine for the U.S. economy.
Okay, consumers still spending. Let's switch gears to tech and recent earnings. Some big names reported. TSMC and Netflix looked pretty good.
Yeah, TSMC had a strong first quarter, profits and revenue up nicely. They sounded really optimistic about AI revenue, think it'll double this year, and kept their overall 2025 forecast.
What about tariffs? Did they mention any impact?
They said, so far, no significant impact, but they did acknowledge future uncertainty. Interestingly, Bloomberg analysis suggested part of their strong results might be companies stockpiling AI chips before potential tariffs hit.
Getting ahead of it. And Netflix.
Also, strong Q1, beat expectations on earnings and revenue, positive guidance for Q2, and they specifically said, like TSMC, no major tariff impact on their outlook so far.
So it seems like some of the tech giants are managing okay for now, maybe insulated or just navigating well, but it wasn't all good news in tech, was it?
No, definitely not universally positive. United Health stock dropped after disappointing earnings and guidance. Nvidia stock kept sliding.
And Google had more legal trouble.
Yep, another court ruling against them, illegal monopolization in the online ad market. That's the second big one recently. Plus, you had ASML management expressing uncertainty about the ultimate tariffs impact, and Prologis saying they would have raised their 2025 outlook if it weren't for these recent global tariffs and all the uncertainty they create.
So yeah, a mixed bag in tech too. Some doing great, others facing headwinds, including potential tariff impacts down the line. Okay, quickly, how did all this play out in interest rates and currency markets? Any notable moves?
We did see Treasury yields climb a bit amid all that talk and uncertainty about Powell's potential removal.
Makes sense. The dollar.
The U.S. dollar index ticked up slightly. That was even though the Japanese yen weakened after Japan clarified the U.S. hadn't made specific currency demands in the trade talks. But it's worth remembering, the dollar index overall has been pretty weak so far this year.
And didn't Goldman Sachs change their tune significantly on the dollar's future?
They did. That was a notable shift. Goldman revised their outlook. Now they expect the dollar to weaken.
Why did it change?
They pointed to these higher-than-expected tariffs, which they see as poorly designed. They think it's eroding confidence in U.S. institutions and the dollar's sort of excessive privilege as the main reserve currency.
So where do they see money flowing instead?
They expect the euro to strengthen. They're forecasting the euro to hit $1.20 against the dollar the next year. That suggests a potential shift in capital flows, maybe away from the U.S. towards Europe.
Wow, that's a big call from Goldman, really underlining the potential negative impact of trade policy on the dollar. Okay, finally, looking ahead, what should we be watching for next week? Earnings, data.
Next week's pretty packed, especially for tech earnings. We've got Tesla, IBM, Lam Research, Alphabet, Intel reporting, plus other big names like Boeing, Verizon, AT&T, Merck.
How's earnings season looking overall so far?
A little weaker than average, actually. The percentage of S&P 500 companies beating earnings estimates is lower than the historical norm so far.
And economic data.
We get new and existing home sales, durable goods orders. But honestly, as recent reports suggest, the market's main focus is probably going to stay glued to any news on those tariff negotiations.
Yeah, seems like trade news is trumping everything else right now, so a lot to watch next week. This deep dive, it's definitely highlighted some major tensions, hasn't it? You've got this optimistic trade talk clashing with these more cautious, sometimes worrying realities.
Absolutely.
The whole Fed independence situation feels pretty precarious, and this real risk that tariffs could fuel inflation, even while parts of the economy, like the consumer, still seem pretty strong.
It really shows the incredibly tricky balancing act policymakers are dealing with right now, and just how easily things could cascade if one piece goes wrong. These interconnected forces are powerful.
So, for everyone listening, as you think about all these conflicting signals, strong consumers but rising inflation worries, plus these super complex global trade issues, what single thing do you think will be the biggest driver of economic stability or instability in the next few months? Is it going to be policy decisions out of D.C.? The global trade dynamics, or just whether consumers keep spending, and it really makes you think about the long-term ripples of everything we've talked about today.
That's it for today's Decode. If you found this helpful, make sure to subscribe, and we'll catch you tomorrow, right here on Nora and Noah Decode the Day.